Well, let's move on now and put the spotlight on Ceat. That's the next company on our radar. It has launched a new range of tires under the Sport Drive range that includes ZR-rated 21-inch tires, run-flat tires and low-noise calm tires as well, targeting specifically the luxury and the premium-end SUV segment. Our colleague Sudarshan caught up with Arnab Banerjee, MD and CEO of the company, and began by asking him about the launch.
We have launched 3 tires with new technology. One is the run flat tire, which will keep you safe even if the tire is damaged. You can drive up to 80 kilometers and get it fixed. Second is the calm tire, which is a low noise tire, which is becoming very relevant in terms of long road travel over highways, electric vehicles. And the third is a high speed rating tire, Z-rated tire in 21-inch. So all these tires are targeted towards customers who are evolving from just commuting to exploring on the highways, driving electric vehicles, and also off-roading and going long distances. In terms of strategy, we are targeting the premium end of the market, which is about 8 to 10% of saliency in the overall car tire aftermarket. This is going to grow much faster than the rest of the market, and this is going to grow to 25 to 30% saliency. So if we have ambition to improve our competitive position in the market, then this is a segment where we have to fortify our position. So these 3 launches are going to do precisely that, and there will be many more coming in the near future.
So what will be the price range and any market share that you would be targeting?
See, our market share is about 16% plus overall. So we would definitely like to be over-indexed in this segment. So we would like to have at least 16% or closer to 20% share in this premium segment, which is the 17-inch plus segment, which is what we defined as premium segment is. So these 3 launches are going to aid that process.
So now shifting to operational metrics. So I'll start with the demand issue. And especially on the domestic front, we have seen that over the last at least 2 to 3 months, now apart from 4-wheelers, demand has been sluggish even for 2-wheelers. So how is your ground check? How exactly like your customers are saying?
So I think you are referring to the OEM demand. So yeah, OEM, I think 4-wheeler has been slow in terms of its flattish, low positive. 2-wheeler has been growing well actually. They've just touched the FY 19-20 levels.
Retail sales, if you see like over the last 2 months, it has come down. And like in the last conference, like these companies, even for FY 26, they are not so bullish.
Yeah. Right. So how we are looking at, first I'll address the OEM segment tire sales. So we had mentioned about exiting some vehicles in the last 2 years, which we did because of reasons that these are not going to grow these sizes of tires. So we are coming back into the OEMs basis the approvals that they've got and the visibility of that. So our growth rate in OEM is pretty okay. Even the overall OEM sales is in some segments is slowing down or flattish. That's one. Replacement market size, see the commercial market, commercial tire market, truck bus radial market is going to grow by mid-single digit because that kind of mirrors the GDP growth. The passenger growth has been slow in aftermarket, so we expect that to at least improve to low single digit to mid single digit. 2-wheeler aftermarket growth has been steady, especially led by the scooter tire segment, to about high single digit to almost double digit. Rural market is shaping up well in 2-wheeler. So that's the outlook in terms of demand in aftermarket.
So you are confident of double-digit growth that you have been targeting? And
we would definitely like to target double-digit growth because that's been the momentum for the first 3 quarters.
And what would be the range that you would be looking for FY26?
At this moment, I would like to say we are definitely targeting double-digit growth. So let's make it happen. Yeah.
No, from sales, if I can talk about the margin, because in the last conversation that we had with you, you had told that this year margin can be slightly below the last year that you had done.
FY25.
Correct. So if you can talk about the range that you might be seeing looking at for FY25, and also if you can say for FY26, what would be the range that you would be targeting?
Yeah, we normally don't give a guidance on margin. So you have seen the last 3 quarters, it's been around 12 to progressively down to 10.4. I can share with you that the raw material situation looks flattish. So it has stopped escalating or increasing further. That's a good news. but it has not yet slackened or dropped off. So quarter 4, quarter 1, quarter 3, all will be similar in terms of raw material prices. What that means is that there will be perhaps no erosion of margins, and if we are able to take some price increases, they might accrue to the bottom line. Having said that, this is the busy season for tire trade, so competitive pressures will also be high. How much of that margin we can retain in our quest for market share, we'll have to see. But we are inclined to take some more price hikes in small doses much more frequently over the next 3-4 months.
I was coming to raw material prices. So natural rubber, and both if you can talk about natural and synthetic. So what is the range of rubber prices that normally you are comfortable with? And any price, obviously you are saying that you will be taking price hike, obviously it might be some small, but in the last 1 or 2 months, have you taken any price hike? So first, range of that you would be comfortable with, and price hike that if you have taken.
I would share the range of gross margin that we are comfortable with, because we really don't control the natural rubber prices, right? So we are, the least that we are comfortable with is about 40-41% gross margin. We are now about 5% behind that. So to that extent, we need to correct the gross margin. Of course, we are also looking at zero-based approach to the cost structure. So there will be some impact on the cost side as well. But gross margin, there is a clear scope of improvement by about 5%, which will be done through progressive price hikes of small amounts. We have taken some price hikes by the end of quarter 3, by January end, and we expect to take some more price hikes by end of March, and this approach will continue over quarter 1.
So do you mean to say that like rubber price, whatever is the current rubber price, still it's not at the comfortable range that you would say?
It has settled down at a much higher level than last year, is the reality, right? And there's a supply-demand gap in natural rubber. So it also depends on how the demand situation evolves. Sorry. So demand situation globally, not only India, but US, Europe, and the Chinese market.
So now coming to export front, because that segment also forms around 20% to your revenue. Now considering all these ongoing geopolitical issues and tariff tantrums, how is the order book looking at on the global front?
See, international business is something which is strategic for us, and we have invested in product development and nurturing in Europe, Latin America, and US. We've just launched in US. So it's important, however, it's also most uncertain. But the good thing is that our bets are placed over 3 geographies. Also, Middle East is pretty strong for us. So not everything goes down or goes up together. So we are able to hedge our bets a little bit. Freight rates are coming down. Currency depreciation is good news for international business. So these are the silver linings, I would say. We are getting good market access in Europe. We are looking at growing on a small base in US. So optically the growth will be good. There are some headwinds in Latin America because of protectionist measures. So it's really a mixed bag. And if you're referring to US tariff situation, any increase in tariff has a negative impact on the prospect. But since our base is very small, the material impact, at least in FY26, will not be much.
So in Europe, you're saying that things have improved in the last few months?
For us.
For you? Yeah.
Yes.
Okay.
Yes.
All right, so that's Ceat talking about their strategy ahead as they roll out that new range of tires.